Good morning, hunters. Welcome back to the Daily Hunt for Multibaggers on this Saturday, May 2nd, 2026. What a week it's been, huh?
Indeed, Ethan. We've got a really interesting batch of insights from yesterday, May 1st. Our AI picked up a significant number of discussions across social media, flagging quite a few different stocks. The overall market sentiment we're seeing today is, well, quite mixed. A lot of excitement, but also a healthy dose of skepticism.
That's right, a true hunter's market, I'd say. Let's dig into some of these popular names, because there's a lot of chatter out there about big moves and even bigger potential.
All right, let's kick things off with Poet Technologies, ticker POET. Now, this one is looking pretty grim from our AI's perspective, flagged as very bearish.
You know, Brooke, I did see some buzz around a 2x leveraged ETF for Poet, which in some corners of the internet can generate a lot of speculative interest. That kind of product usually means people are expecting some dramatic upward swing, right? A lot of community optimism if they're gearing up for that kind of play.
Well, Ethan, that speculation feels more like a warning sign than an opportunity in this case. Our analysis found overwhelming user sentiment calling it a falling knife, and frankly, some even called it a Ponzi scheme. When you look at the KPIs, it's clear why. The company has a net profit margin of 0, negative earnings per share at minus 0.68, and a significant debt-to-equity ratio of nearly 4. Even Jim Cramer called it more of a science project than an established business. We had Poet rated stay away just last week, and honestly, nothing here suggests an upgrade.
Ouch. I guess that's one for the proceed with extreme caution pile.
Exactly. Our verdict for Poet remains stay away. The fundamental financial health simply isn't there to support any speculative upside.
Okay, let's move on to a market favorite, NVIDIA, ticker NVDA. This one, has been a powerhouse, and I saw some news about them landing Pentagon deals for classified AI work. That sounds like a solid revenue stream and a huge vote of confidence in their technology. Plus, Bank of America is still maintaining a buy rating, and insiders are net buyers.
Ethan, while the news of government contracts is indeed a business development, the social media discussions quickly turned skeptical. Users were calling the entire AI sector a bubble and suggested these government contracts might be more about bailouts or easy money for desperate companies rather than a sign of sustainable growth. The valuation metrics here are astronomical, a PE of over 40 and a price to book of 30.66. And let's not forget that high debt-to-equity ratio of 7.255. Even with strong revenue growth and net profit, those multiples signal extreme risk. NVDA was a buy for us yesterday, but the current analysis flags it as slightly bearish due to these concerns.
So even with all that growth potential, you're saying the price is just too high for the risk?
For now, yes. Our verdict for NVDA is stay away, given the high valuation and user concerns about an AI bubble. The strong insider buying is a positive signal, but it's not enough to offset the current risk profile.
All right, changing gears now to Interactive Brokers Group, IBKR. I didn't see much user sentiment here, but the news looks pretty solid. Q1 earnings beat estimates, they increased their dividend, and they're even integrating crypto trading. That sounds like a company expanding and rewarding shareholders.
You're right, Ethan. There wasn't much user chatter for IBKR, so our AI assessed it as neutral on that front. But the KPIs are definitely compelling. We're looking at 16.8% annual revenue growth and a healthy 16.1% net profit margin. Their return on equity is impressive at 23.56%. While the PE is on the higher side at 34.68 and the debt to equity is very high at 150, that level of leverage isn't uncommon for a financial institution. This stock was previously a buy for us back in October, and it's continuing to show strong operational and financial health.
So a solid performer, even if it's not making the viral rounds.
Absolutely. Our verdict for IBKR is a buy, supported by strong growth, profitability, and an increased dividend. Next up, Intel, ticker INTC.
Now, this one, Brooke, is an absolute rock star on social media right now. Users are celebrating it, breaking the $100 mark, regretting selling early, and some are even predicting it's going to moon. Analyst firms are boosting price targets to 118, and we've seen a 115% rally in April alone. Insiders are even buying up shares. What a comeback story.
Ethan, that comeback story is where fundamental analysis diverges from pure market excitement. Despite the incredible rally in user enthusiasm, Intel is still fundamentally unprofitable. Its net profit margin is negative, and so is its earnings per share. And let's talk about the debt-to-equity ratio. It's an alarming 36.028. That's massive leverage for a company that isn't generating profits.
While the stock price is at a 52-week high, our previous rating was cautious buy just a few days ago, and before that, mostly stay away ratings. The current financials simply do not support such an elevated valuation or continued unbridled optimism. But the rally, Brooke, it's undeniable, and insiders are buying. The rally is driven by speculation and future expectations, not current financial performance. The high debt and unprofitability present significant risks if those future expectations aren't met. Our verdict for Intel is stay away. The fundamentals don't align with the current market valuation.
Okay, let's talk Tesla, TSLA. I'm seeing a lot of discussions about their ambitious future with robotaxis, AI chips, Optimus. Elon Musk is pushing the boundaries, you know? They're burning billions to build this AI future, and it sounds like they're poised to revolutionize multiple industries. Plus, insiders are net buyers.
Ethan, while the vision is grand, the user sentiment our AI picked up is overwhelmingly skeptical, even bearish. Many comments call FSD and robotaxi unfulfilled promises or fantasies, pointing out how long these technologies have been a year away. The valuation is staggering, a PE ratio of 358.55 and a PEG ratio of 5.25. That means a huge amount of future growth is already baked into the price, and then some. Their net profit margin is quite low at under 4%, and the debt-to-equity ratio is high at 18.738. Tesla has been stay away for us for quite a while now, with a few speculative gamble thrown in.
So all that innovation isn't enough to justify the price for you?
Not at these valuation metrics, no. The company is investing heavily, but the skepticism about profitability and the extremely high valuation present a significant risk. Our verdict for TSLA is stay away.
Okay, let's pivot to Advanced Micro Devices, AMD. I'm hearing a strong long-term preference for AMD from users, with expectations that they're going to crush earnings on May 5th. They've doubled their data center deals, and there's talk of new catalysts beyond AI. That sounds like a powerful growth trajectory.
Ethan, I agree the revenue growth for AMD is fantastic at over 34%, and a net profit margin of 12.5% is solid. The PEG ratio of 1.05 is also quite favorable, suggesting that its high PE of 138.67 is somewhat justified by its growth. And yes, insiders have been net buyers. However, it's trading very close to its 52-week high, and it has a high beta of 1.963, meaning it's very volatile. Cathie Wood's ARK Invest has been selling shares, which is a notable institutional bearish signal. While the upcoming earnings could be a catalyst, buying at these levels with such a high PE and volatility requires a very cautious approach. We've had a mixed history with AMD, from stay away to buy.
So strong growth, but maybe a bit hot right now?
Precisely. Our verdict for AMD is cautious buy. The growth is compelling, but the valuation and volatility warrant prudence.
All right, let's wrap up our individual stocks with Avis Budget Group, CAR. I saw some user posts about a car rally and a potential bump from the World Cup. Maybe it's undervalued after a big drop? Insiders are even showing net purchases over the last 6 months.
Ethan, you're looking at the wrong kind of gains there. Our analysis clearly showed that many users profited from shorting CAR, not from it going up. They explicitly talked about a violent crash and negative profits and negative equity. The KPIs are genuinely concerning: a negative net profit margin, negative earnings per share, and critically, a negative price-to-book ratio of minus 1.917. This implies that liabilities outweigh assets. The stock has plummeted over 75% from its 52-week high, and users reported extreme volatility and trading halts. This has been a consistent stay away for us.
Wow, negative price to book. That's a tough one to spin positively.
It is. Our verdict for CAR is stay away. The fundamental financial health is in severe distress.
And finally, Palantir Technologies, PLTR. I'm seeing a lot of excitement here. Users transferring profits from other stocks right into PLTR, talking about a Valhalla moment. With those new USDA AI deals, their AI momentum is clearly picking up. Plus, those net and operating margins are looking very strong.
Ethan, Palantir's margins are indeed strong, and new AI deals are positive. However, the valuation metrics are astronomical: a PE ratio of 228.68, a price-to-book of 46.63, and a PEG ratio of 2.84. These numbers mean a tremendous amount of future growth is already priced in. What's more, insiders have been net sellers over the last 6 months, disposing of over 2 million shares. That really counters the retail investor enthusiasm.
PLTR has generally been a stay away or speculative gamble for us previously.
So even with the AI buzz and user excitement, the numbers are saying slow down?
They certainly are. Our verdict for PLTR is stay away. The extreme valuation, coupled with insider selling, makes it a high-risk proposition right now.
All right, that was a whirlwind. So to quickly recap our top candidates for deeper analysis from today's hunt: Investigate as buy, Interactive Brokers Group, IBKR; Investigate as cautious buy, Advanced Micro Devices, AMD; Investigate as speculative gamble, Intel Corporation, INTC.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for joining us on the Daily Hunt for Multibaggers. We'll be back soon with more AI-generated insights to help you navigate the markets. Until then, happy hunting.